is day trading? Why is it so special? How to do trade trading? Advantages, disadvantages, checklist before day trading. What is day trading? When you buy a stock and sell it on the same day, it is called as day trading. Stock market opens at 9 a.m. and closes at 3:30 p.m. Everyone knows it. It is a common, Indian market structure which opens at 9 a.m. and 3:30 p.m. Okay. So what happens is 9 a.m. to 9:15 a.m. will be pre-market session. 9:15 to 3:15 is the actual market where the market actually operates, and 3:15 to 3:30 is after market session. So these are the important things that has to be kept in mind. Okay. So now, for example, if you buy a stock at 9:15, you must sell it before 9:30 p.m. You need to completely exit from the particular stock before 3:30 p.m. So that's very important for you to exit. So one more thing, if you're buying a stock, as you clearly know, market is from 9:15 to 3:15. So any intraday positions that you're carrying, you need to exit before 3:15. Or after 3:15, automatically the broker will square off your position, irrespective of it being in profit or in loss. What is special about day trading? Another word for day trading is, it is also called as intraday trading. Leverage. So let's come more into leverage. Leverage is a very, very important thing that we will be learning in this particular module. So what is leverage? Leverage strategies. Leverage strategies is basically like, it is like taking a loan from the broker. It is like taking a loan from the broker. For example, you want to trade on intraday basis. You have a capital of 1 lakh. Okay. Let's consider a particular stock which has got a share price of 1000. Okay. A particular stock, it can be Tata Steel, which is running at 1000 rupees. One share of Tata Steel is equal to 1000 rupees. So if you have a capital of 1 lakh, you can buy 100 shares of Tata Steel. Right. Yes. But if you're trading on intraday basis, even with 1 lakh rupees capital, you get margin of 5x. Meaning, even with a capital of 1 lakh, you can get a leverage of 5 lakhs. So instead of you have only bought 100 quantities, you have money only to buy 100 quantities. But because of your 5x leverage, you will get a chance or a ownership of 500 quantities for that particular day. This is called as the importance of leverage or margins. And that is why lot of retail investors, because in this case what happens, even if you have a capital of 10,000 rupees, you will get a leverage up to 50,000. Even if you have a capital of 1 lakh rupees, you get leverage of 5 lakhs. If you have a capital of 5 lakh, you get leverage of 25 lakhs. This will actually encourage lot of investors, even with small capital, to come into the market because they are getting a very good margin. And this is the reason lot of people do trading, because they can make huge profits with small capital. I hope this is crystal clear. In simple words, leverage is the additional capital which is provided by broker for us so that we can buy and sell more number of shares. For example, if I have 1000 rupees in my trading account and the leverage provided by the broker is 20x, we can buy shares for 20,000 rupees. 19,000 is borne by the broker on behalf of us. This in turn increases purchasing power of day traders. Let's understand the concept of leverage with the help of an example. So for example, normal investment. Cash in trading account is rupees 1000. Current market price of TCS is 1000. Buying TCS at 1000 rupees, you can buy only one share. Sell TCS at 1100, you will get profit of 100 rupees. Cash in trading account, again, day trading example. So this was the normal investment, because what happens in normal investment is, if you have bought one share of TCS at 1000, if TCS has moved from 1000 to 1100, you are in a profit of 100 rupees. You can exit at a profit of 100 rupees. No problem. You don't get any leverage. But let's come to a leverage example. That is a day trading example. If the cash in trading account is rupees 1000, leverage provided by the broker is 20x. So cash available to purchase the share is 20 into 1000, which is 20,000. Buying TCS at 1000 rupees, number of share brought is 20 shares. Okay, because normally you have bought only one share, but you have bought 20 shares through the margin they have offered to you. Okay, so profit is 20 shares into 100, which is 2000 rupees. So just with a capital of 1000, you have made a profit of 2000, which is a 200% return. Okay, so let's move forward. So you know the difference now clearly. What is it showing you in the screen? Normal investment and day trading, the big difference behind it. Okay, So there might be some questions in your mind about leverage, because as we're talking about leverage strategies, there might be some important questions in your mind regarding the leverage. Okay, so when it comes to the leverage, what if you buy using leverage and price comes down? If you buy using leverage and the price comes down unexpectedly, there are possible chances of huge losses. There is a chance you might lose your entire amount also. There is a chance of a huge loss, because see, when you're buying something through a margin, when you're buying something or when you're investing through a margin, it's like taking a loan from the broker. Okay, it is like taking a loan from the broker. So when you're making losses also, there is a huge chance of you making a big loss. So that is something you need to keep in mind. So only when you're sure about fundamentals, only when you're sure about technical analysis, that is the place you need to invest using margin or leverages. It can wipe up your entire trading account, as I already said. Okay, so now how can we avoid such losses? In order to avoid such losses, as I already mentioned, you need to really understand the market, price action. You need to understand about fundamentals, technicals. You must learn the corner of day trading first. Having the accurate knowledge and practicing it with proper discipline is the key behind this. Anything you do in life, knowledge or education is important. Half knowledge is very dangerous in stock market. Suggest them not to invest in the market. Only full knowledge is going to give you reward in the market. Learn is equal to earn. Another way to limit losses is by putting a stop loss order. The exact working of stop loss order will be demonstrated in the next slide. Let's assume that you have bought 1000 quantity of Tata Motors at 70 rupees. You expect the price to go up to 90 rupees. Okay. Expected profit is rupees 20,000 rupees. Because let's consider, you bought 1000 quantity of Tata Motors at 70 rupees. Okay. So you are expecting Tata Motors to go to 90 rupees. So expected profit is 20,000 rupees, obviously. But what if the price dropped to 45 rupees? Let's consider the situation. What if the price dropped to 45 rupees? You will have a loss of 25,000. In order to avoid that huge loss, a stop loss order can be placed. Once buy order of 1000 quantity is placed, immediately place a sell order. Sell order meaning whenever you are buying, if for example in this example you have bought Tata Motors at 70 rupees, you should keep a maximum loss, maybe a stop loss at the price of 65 or 60 rupees, because 5,000 to 10,000 rupees, that is a loss that you can bear, or depending on your risk appetite, you need to keep a proper stop loss. Okay, you need to set trigger price at 65. Yeah, as I just said, you expected price to go from 70 to 90, but if the price starts falling from 70, broker will automatically sell your shares once the price is 65, thus saving you from huge losses. There is only loss of 5,000 when stop loss order was placed, but if SL order wasn't placed, the loss would have been 25,000. So we need to understand these important things here. Let's move to the advantages of day trading. See, as of now, some people tell positional trading is safe, because what happens in positional trading is when you buy a stock, even if you're in profit or loss, there is no particular thing that you have to exit in that particular day itself. When you're buying something, when you're buying a stock through positional basis, there is no requirement for you to exit in the same day. There is no such rule. Even if you are in profit, even if you are in loss, you can carry it forward, because that is investing. But in day trading, if you are buying a particular stock that day, you need to exit before 3:15, irrespective of you being in profit or loss. So that is important. So advantages of day trading is, one is leverage, one is short selling. You can take sell trades, that is selling at a higher price and buying at a lower price. That is only possible in day trading. There is no overnight risk. There is no tension after you complete the trading that particular day. Offers flexibility and convenience. You get a good level of flexibility and convenience when you're doing day trading. And real liquid cash. So there is liquidity. Liquidity is something that can be converted into cash very fast. Okay, so in day trading, that is a very important thing. What are the disadvantages? Majority traders make loss rather than profit. They can be greed, they can be fear, which are the two important pillars that can cause a loss. Okay, demands lot of time and attention. When you're in the markets, you need to focus, you need to give time to the market and attention to the market. Deep learning and extensive practice is required. Obviously, if you have to be a very good trader, fundamental analysis, technical analysis, all the knowledge in and out is required. You need to be mentally and emotionally strong. You need to be very strong mentally and emotionally. Don't worry, it's due to lack of knowledge. That's the main reason I'm here to teach you. that all these things happen, like mental, like greed, fear, balancing greed and fear. That's really important in stock market, and I'm here to teach you that. So we are all good to go.